For those who've put on the uniform and served our nation, the VA home loan program can be, well, a cornerstone of their financial future, a real opportunity to build stability.
Oh, absolutely.
But the process of getting those loans to veterans involves a pretty intricate system, right, of approved lenders, all playing by a specific set of rules to ensure everything is done correctly.
That's exactly right.
Yeah.
And that's what we're going to explore today. We've taken a close look at Chapter 1 of VA Pamphlet 26-7.
Okay.
Which is, essentially the VA's guidebook for how lenders get the go-ahead to participate in the VA loan program.
Right, like understanding who gets the keys, basically.
Precisely. Who gets the keys to help veterans achieve homeownership?
So our goal for this deep dive is to really understand the landscape of VA lender approvals. We want to clarify the different types of lenders out there, how they earn the VA's trust, get authorized, and what enables some to close those crucial loans automatically.
Yes, streamline the process.
Exactly. Ultimately, it's about providing a clear picture of who can offer these vital loans and under what conditions, kind of a behind-the-scenes look at how this really important process works.
Absolutely. So to kick things off, let's define our terms, maybe.
Good idea.
When we talk about a lender in the VA loan context, we're referring to, well, any entity involved in a VA-backed loan at any stage.
Any stage.
Yeah, this could be a familiar name like a bank or a credit union, maybe even a government entity. They handle everything from the initial application all the way through to, potentially selling the loan later on. It's a pretty broad scope.
Okay, so a wide net. Now, within this large group, the VA makes some important distinctions. I'm seeing terms like supervised lenders and non-supervised lenders. What's the main difference we should grasp there?
Okay, yeah. The key difference really lies in who's keeping an eye on them.
Yeah.
A supervised lender is an institution that's already subject to regular mandatory examinations and oversight by a government agency, either federal or state level. Think of your big national banks. Credit unions insured by the FDIC, that's the Federal Deposit Insurance Corporation.
Right.
Or the NCUA, the National Credit Union Administration. Even state-chartered banks and insurance companies fit here.
So the VA basically recognizes that they're already being watched.
Exactly. They're already under established regulatory scrutiny. And this kind of two-tiered system allows for both those large, well-established players and maybe smaller, more specialized lenders to be involved.
But with different levels of checks, right? To balance accessibility with responsible lending.
Precisely.
Yeah.
Balancing access and responsibility.
That makes sense. There's already a system in place holding them accountable. And on the other hand, we have non-supervised lenders. That's pretty much anyone who doesn't fit into that supervised category.
Exactly. Anyone not meeting that definition. Now, within that non-supervised group, there's another really important distinction. The non-supervised automatic lender. These are lenders who've specifically applied to the VA, gone through a process, and have been granted the authority to close VA loans automatically.
Meaning they don't need the VA's explicit okay for every single loan before it closes.
Correct. And this ability to close automatically can really, streamline the process for veterans. Makes things move faster.
Automatic authority. Yeah, that sounds like a significant step in terms of efficiency. Now, what about the folks who aren't actually funding the loans themselves, but are still part of the process? I'm seeing agent, sometimes called a mortgage broker, and sponsoring lender. How do they fit in?
Right. So an agent or mortgage broker acts on behalf of a lender.
Okay.
They might work directly with the veteran, help them with the application, gather all the necessary paperwork, essentially handle many of the initial steps in the lender's name.
And the sponsoring lender?
That's the financial institution that uses that agent. And this is a really critical point. The sponsoring lender takes full responsibility for everything their agents do.
Everything.
Or don't do, yeah. During the entire loan process, it's like, think of a driver with a learner's permit. The supervising driver is ultimately responsible.
Right. So if an agent makes a mistake, the VA holds the lender accountable, not just the agent.
That's it.
Wow, that really underscores how important it is for lenders to choose their agents carefully and, make sure they're well trained.
Absolutely crucial. Now, you also saw mention of mergers and acquisitions.
Yeah, just a quick note, that sounds like it could really complicate things potentially.
It certainly can. When lenders merge or one company buys another, it can definitely impact their VA loan status. We'll circle back to the specifics on that later, but yeah, it's something the VA watches closely.
Why so closely?
Well, to ensure ongoing compliance and stability within the program. The VA's concern is that new ownership might bring changes. changes in financial stability, maybe expertise, or even just adherence to the VA's standards. So they check.
Okay, makes sense. Studying with the different types of lenders, what about prior approval lenders? That sounds like, well, the opposite of automatic.
Exactly. A prior approval lender is one that isn't classified as either supervised or a non-supervised automatic lender.
Okay.
For these lenders, almost every single VA loan they want to originate has to be submitted to the VA for their underwriting review and approval before it can actually close.
So a more cautious approach.
A more hands-on approach from the VA, yeah.
Almost every loan. Are there any exceptions for these prior approval guys?
Yes, there's one notable exception. Non-delinquent interest rate reduction refinancing loans. You'll hear them called IRRRLs.
IRRRLs, got it. Like streamlines.
Exactly. Even lenders who generally operate under prior approval can typically close these types of refinances without getting the VA's upfront sign-off, as long as the original loan isn't delinquent.
Got it. So if you're not under existing supervision and you haven't specifically been granted automatic authority, you're mostly in the prior approval category. But it seems like even lenders with automatic authority might still need to get prior approval sometimes.
That's right. The guidelines spell out certain types of loans that always require the VA's prior approval. Doesn't matter what the lender's general automatic status is.
Oh, really? Like what kinds?
Things like joint loans, whether it's between two veterans or a veteran and a non-veteran.
Yep.
Loans for veterans who are receiving a non-service connected pension, or maybe have a VA-appointed fiduciary managing their affairs.
Right, special circumstances.
Exactly. And those IRRLs we just mentioned, if they're refinancing a VA loan that's actually delinquent, that needs prior approval too.
Ah, okay. So delinquency changes the game for IRRLs.
It does. Also, most loans for manufactured homes and any loan that isn't secured by a first lien on the property, those also fall into this mandatory prior approval bucket.
So these are often just more complex situations that warrant that extra layer of VA review.
That's the thinking, yeah. An extra set of eyes from the VA.
Now, you mentioned that even automatic authority lenders can choose to get prior approval on other loans if they want to. Why would they do that if they don't have to?
Well, sometimes a lender with automatic authority might run into a loan scenario that's particularly complex or, unusual, something their own underwriting team might not feel entirely comfortable with.
Okay.
In those cases, they have the option to submit it for prior approval just to get the VA's expert input. But here's the crucial thing.
What's that?
They can't use prior approval as a way to just, dodge responsibility if the VA ends up rejecting the loan later.
Ah, they can't just pass the buck.
Exactly. They can't just shift the decision and the accountability to the VA in routine cases.
Right, they can't just shift the responsibility. Whereas if you don't have automatic authority, you pretty much have to get prior approval for everything except those non-delinquent IRRLs we talked about.
Correct. That's the default for them.
Okay. Now, let's talk more about this automatic authority itself. What does it really mean for a lender in, practical terms?
Well, just like the name suggests, it's the ability to close VA-backed loans without needing that pre-approval from the VA for each one.
Which, as you said, can significantly speed up the process for veterans.
Definitely.
So who is eligible to get this automatic authority? Who gets this power?
The primary groups are, first, all supervised lenders, like we discussed those already under existing federal or state oversight.
Okay.
And then there are those non-supervised lenders who have specifically applied for and been granted that authority by the VA after, proving they meet the necessary qualifications.
Right, the ones who go through that application process.
Exactly. And finally, as we've touched on, any lender, regardless of their general status, can automatically close non-delinquent IRRLs. That's the exception.
So two main paths to automatic authority plus that specific IRRL exception. Now, are there key differences in how supervised and non-supervised automatic lenders operate with the VA once they have this authority?
Yes, there are some important distinctions, actually. Supervised lenders don't need to get specific VA approval for either their automatic closing authority itself or for the individual underwriters they employ.
Oh, interesting. Why not?
The VA essentially relies on their existing regulatory oversight. The assumption is that oversight ensures they have qualified personnel.
Okay.
Non-supervised lenders, on the other hand, have to actively apply for and receive VA authorization for automatic authority, And they also need the VA to individually approve each person who will be underwriting VA loans under that authority.
So another layer of checks and balances for the non-supervised ones.
Precisely. More steps to ensure they're meeting the VA standards.
But it sounds like once both types have that automatic authority, they can operate nationwide, no state limits.
Exactly. As long as they continue to meet the VA's requirements, their automatic authority isn't restricted by state lines.
And using agents. Sounds like both supervised and non-supervised automatic lenders can use them, but there's still a VA process involved for the agents themselves.
Yes, that's consistent. Regardless of whether a lender is supervised or non-supervised automatic, they both need to formally request and obtain VA recognition for every agent they have an ongoing business relationship with.
Okay, that agent recognition part is universal for automatic lenders. Which brings us back to the IRRL exception. You mentioned any lender can do those automatically. Does that mean all the usual rules for automatic authority and underwriters are, like, waived for those specific loans?
For non-delinquent IRRLs, yes, pretty much. Any lender can close them automatically nationwide without needing specific VA approval for their general automatic authority, their individual underwriters, or even the state where the loan is being made.
Wow, okay.
However, and it's important if they use an agent to process that IRRL, they still need to obtain VA recognition for that agent, just like they would for any other type of VA loan.
Okay. So the agent recognition piece is constant across the board, even for IRRLs.
That's the key takeaway there. Agent recognition is always required if an agent's involved for an automatic lender.
Okay, we've defined the players and the basic rules. Now, what happens before a lender can even start making VA loans? What are the very first steps they need to take, to get in the door?
Right. For any lender looking to get into the VA loan program for the first time, doesn't matter if they're supervised, aiming to become non-supervised automatic, or just planning to operate on prior approval, there's an initial package of info they need to send.
Okay, an info package. To who?
To the relevant VA Regional Loan Center, the RLC, or maybe the Honolulu Regional Office, depending on their physical location. And the VA provides a website, which is handy, where lenders can easily find the specific office they need to contact.
And what kind of information does the VA want to see in this initial package from a brand new lender?
They're looking for a few key things to get the ball rolling. First, they need specimen signatures of everyone who'll be authorized to sign VA loan documents.
Like officers, underwriters?
Yeah, officers, underwriters, other relevant folks. They also need VA Form 26881, which is the VA Equal Opportunity Lender Certification. Shows commitment to fair lending.
Makes sense.
And finally, they need a letter. This letter needs to identify the lender's corporate address, the full names of all the owners, details about any lending personnel or officers who've ever been debarred or faced adverse actions from VA or HUD.
Oh, okay. Need to disclose that up front.
Definitely. And also a full list of all their branch offices that will be involved in VA mortgage lending. It helps the VA get a clear picture of who they're dealing with right from the get-go.
Sounds like the VA is doing their homework right from the start. And I see a note here that they might even run a credit report on the lender itself and maybe interview top executives.
That's correct. The VA absolutely reserves the right to conduct further investigation, to check out the lender's overall financial standing and, their responsibility as a potential participant in the program.
So the lender sends this initial package off. What happens next? What does the VA do?
The VA Regional Loan Center then takes over. They provide the lender with essential info, including training on the specific processes for VA loans.
Okay, training's involved.
Yeah. They'll also issue a unique VA ID number, which the lender has to use on all VA-related documents from then on.
Right.
The lender also gets pointed to the online VA Lender's Handbook, which, as we've said, is VA Pamphlet 267, our source today, and they'll strongly encourage them to sign up for GovDelivery to get important updates and announcements directly from the VA.
So the RLC becomes their main point person.
Essentially, yes.
Yeah.
The RLC is the primary contact for all things VA loans.
Okay, so it's a two-way street of information sharing to get things started. Now, when can a lender actually start making these VA loans? Is there a waiting period?
Well, once a lender has taken the time to really get familiar with all the relevant laws, regulations, and procedures, they can start making VA loans. However, the specific process they follow depends on their classification.
Oh, okay. How so?
Supervised lenders, those already watched by federal regulators, can generally start closing loans automatically almost immediately.
Right away.
Pretty much. The exception being those specific loan types that always need prior VA approval, no matter who the lender is.
And what about the non-supervised lenders just starting out? Do they have to wait?
Non-supervised lenders, yeah, in the beginning, they'll typically need to submit almost all of their loan applications for prior VA approval,
Except for...
except for those non-delinquent IRRLs we talked about.
Yeah.
To get the ability to close other loans automatically, they need to go through that separate process of applying for and getting that specific automatic authority from the VA.
Okay.
And even those lenders who are maybe seeking recognition as supervised, they also have to use prior approval until that official recognition comes through.
So the supervised lenders definitely have a bit of a head start in terms of getting things moving automatically.
They do, yeah. Less initial red tape for automatic closing.
Let's dig a little deeper then into exactly who qualifies as a supervised lender. You mentioned a specific list of government entities involved?
Yes. The VA automatically considers any lender that is subject to mandatory periodic examination and ongoing supervision by certain key federal entities to be supervised.
And who are those key entities?
The main players are the Board of Governors of the Federal Reserve System, the FDIC, Federal Deposit Insurance Corporation, the Controller of the Currency, the NCUA, National Credit Union Administration, and the Farm Credit Administration.
Okay.
If your institution is supervised by one of those, you don't even need to separately ask the VA for recognition as supervised.
So you just tell them who your supervisor is?
Pretty much. You just identify your primary federal supervisor in that initial info package you send. It's a pretty straightforward recognition based on that existing oversight.
That seems pretty clear. But what if a lender isn't directly supervised by one of those big federal agencies, but still thinks they should be recognized as supervised by the VA? Is there a path for that?
There is, but it's got specific requirements. Such a lender has to be a wholly owned subsidiary or a direct affiliate of a lender that the VA already recognizes as supervised.
Ah, okay, like under their umbrella.
Exactly. In that case, they need to specifically apply to the VA for recognition as supervised and provide detailed documents showing that relationship clearly.
What kind of documents?
Things outlining their organizational structure, their capitalization, their ownership, proving the connection to the already recognized supervised lender. The VA reviews it all and then lets them know their decision.
So they're checking to make sure they really fall under that established supervised umbrella.
That's the goal, yeah. Ensuring they're effectively covered by that existing supervision.
Now, once a lender is officially considered supervised by the VA, what does that generally mean for how they operate VA loans?
Well, as we mentioned, being classified as supervised typically grants them automatic authority to close VA loans without needing prior VA approval on each one.
Except for those mandatory prior approval loan types.
Right, always those exceptions. However, even supervised lenders aren't entirely free of ongoing responsibilities with the VA.
Oh, what else do they need to keep track of?
They are still required to get formal VA recognition for any agents they use to originate VA loans.
Ah, the agent recognition again.
Yep. There's a specific process for that, which we'll get into. And importantly, if a supervised lender does use agents, they have an annual requirement.
What's that?
They have to submit a list of all their VA-recognized agency relationships they want to renew for the next year, along with the annual renewal fees.
When is that due?
Typically by January 31st each year. And they also need to provide any other info the VA might ask for related to these renewals. It's really the lender's job to make sure this gets done on time, even if the VA doesn't send a reminder.
And what happens if they miss it? Or don't pay the fees?
Failure to pay those annual renewal fees could actually lead to a suspension or even loss of their automatic processing authority, specifically for any loans originated by those agents whose fees weren't paid.
Wow, okay. So even with the benefits of being supervised, there are still important ongoing admin duties, especially if agents are in the picture.
Definitely can't forget those agent requirements.
Okay, so that covers the supervised side fairly well. Now let's shift focus to those non-supervised lenders who are aiming to get that automatic authority. What does the application process look like for them? It sounds more involved.
It is generally more involved, yes. For a non-supervised lender to apply for automatic authority, they need to start by filling out VA Form 268736.
Okay, specific form.
Right, it's specifically titled Application for Authority to Close Loans on an Automatic Basis, Non-Supervised Lenders. This completed form, plus all the required supporting documents and the fees, needs to go to the VA office that has jurisdiction over their main home office.
And they also need that initial lender info package stuff too, right? If they haven't sent it already.
Correct. They need to provide that initial info or at least any updates to it, like a current list of all their branches involved in VA lending.
Okay, so a formal application package. What are the key criteria the VA is looking at when they review these applications from non-supervised lenders? What makes them say yes?
The VA looks at several critical areas. One of the most crucial is lender experience.
Experience in VA lending specifically?
Yes, and there isn't just one way to meet this. The VA offers a few different paths, which is good.
Like what?
For instance, they might need to show at least 2 years of active experience originating VA loans. A&D have closed at least 10 VA loans in the past 2 years.
Okay, 2 years and 10 loans.
Or if they have less than 2 years experience, maybe they need to show a higher volume, like closing at least 25 VA loans in that shorter time.
So more volume compensates for less time.
Kind of, yeah. There's also a path if a principal officer who actively manages their VA loan origination has at least 2 recent years of management experience in VA lending within the last 5 years.
Ah, so management experience counts too.
It can, and there's even an option for lenders who've been operating as agents for other automatic lenders.
Oh, interesting. How does that work?
They need to show they've originated at least 10 VA loans over the past 2 years as an agent, or 25 if their agent experience is less than 2 years.
So VA recognizes different types of relevant experience. That seems flexible.
It allows for different backgrounds in the mortgage field to be considered, yes.
Now, I see a note here that IRRLs do not count towards these specific origination experience requirements. Why is that distinction made again?
Right. That's because IRRLs, being streamlined refinances, typically involve a less comprehensive credit underwriting process compared to, say, a purchase loan or a cash-out refi.
Ah.
The VA wants to see demonstrated experience handling the full scope of credit and underwriting evaluation, which standard IRRLs just don't fully represent.
That makes perfect sense. So aside from the overall lender experience pathway, what other documentation is generally needed for all of these different experience qualifications?
Regardless of which path they're using, there's a core set of documents they'll usually need. This includes that completed VA Form 268736, their VA ID number.
Got it.
Detailed resumes for all principal officers involved in managing loan origination, clearly showing their mortgage lending experience. And proof that they've completed the mandatory VA underwriter training that needs to be done within 90 days of their underwriter getting approved.
Okay, core package. And for those lenders qualifying based on their agent experience for another lender, there's some extra paperwork, right? More proof needed.
Yes, definitely. If they're using their agent track record, they also need to provide a copy of the official VA letter that recognized them as an agent for their previous sponsors.
Okay.
A copy of the corporate resolution their sponsoring lender submitted to the VA, the one outlining what functions they were allowed to perform as an agent.
Right.
And a formal letter from a senior officer at that sponsoring lender. This letter needs to detail how many VA loans they submitted each year as an agent and crucially confirm that they did it all in compliance with VA requirements.
So the VA wants confirmation from an established lender about their competence.
Exactly. It provides assurance from someone already in the system about their operational abilities.
Okay, so the VA wants to see not only that they've originated loans, but that they've done it right under the guidance of an established automatic lender. Now, another key piece for non-supervised lenders is having qualified underwriters. What are the specific requirements there?
Right, this is essential. A non-supervised lender applying for automatic authority has to have at least one full-time employee nominated by a senior officer to be their VA underwriter.
And how does that person qualify?
To be considered qualified, that individual needs to meet one of 2 main criteria sets. Option 1, at least 3 years of experience in processing, pre-underwriting, or directly underwriting mortgages.
Okay, 3 years total.
With at least 1 year of that experience being recent within the last 3 years, and specifically involving making final underwriting decisions on VA loans.
So recent specific VA decision-making experience. What's the other option?
The alternative is for the nominated underwriter to currently hold a valid AMP-accredited mortgage professional or CRU certified residential underwriter designation from the Mortgage Bankers Association.
MBA certifications, okay.
And critically, all VA-approved underwriters, no matter how they qualify, must have a thorough understanding of the VA's credit underwriting standards found in the Lender's Handbook.
So it's either demonstrated direct recent VA experience or holding recognized industry certification, plus knowing the VA rules inside and out. What kind of documentation proves this to the VA?
For all underwriter nominations, the lender needs to submit VA Form 268736A.
Another form?
Yep. Non-supervised lender's nomination and recommendation of credit underwriter must be fully completed and signed by a senior officer.
Okay.
Additionally, if the nominated underwriter isn't physically located at the lender's main corporate office, they also need a certification from another senior officer.
Certifying what?
Certifying that the underwriter reports to and is directly supervised by someone in the organization who does not have production responsibilities.
Ensuring independence from sales pressure.
Exactly. Their focus should be quality and compliance, not loan volume. Now, if the underwriter is qualifying based on the 3 years of experience, they need to submit a detailed resume that specifically outlines their VA loan experience. And just to repeat, IRRLs don't count for this.
Got it. No IRRLs for underwriter experience either.
Correct. If they're qualifying based on holding a current AMP or CRU designation, they just need to provide official documentation proving that designation is active and in good standing.
Okay, that covers the experience for both the lender and their underwriters. Are there any other essential hurdles a non-supervised lender needs to clear for automatic authority?
Yes. The VA also puts significant weight on what they call sanctions for prior acts.
Sounds serious. What does that mean?
Essentially, they do a background check. They review the history of the lender itself and their principal officers to make sure there's nothing indicating a potential lack of care or diligence needed for VA loans.
Like what kind of history?
If the lender or any director or principal officer has ever been formally debarred, suspended, or sanctioned by any government agency, or if any director or officer was previously with a firm that got debarred or suspended, or if they've had a servicing contract terminated for cause, they have to submit a full statement of facts to the VA explaining the situation.
So full disclosure is required.
Absolutely. It allows the VA to make an informed decision about their suitability for automatic authority.
That really sounds like the VA trying to safeguard the program's integrity and ensure responsible lending. I also noticed a mention of an application checklist in topic 15 of the handbook. Seems helpful.
Exactly. Topic 15 provides a really useful checklist summarizing all the essential application materials and key requirements we've been discussing. It's a handy quick reference for lenders putting their package together.
And once a non-supervised lender successfully navigates all this and gets approved for automatic authority, is that authority just for like their home state or broader?
No, once they're granted automatic authority by the VA, that authority is effective nationwide.
Nationwide. That's good to know. So after they submit all this detailed information, how does the VA actually let them know the decision?
The specific VA office that reviewed the application makes a formal determination and then issues a written notification of their decision directly to the lender.
Okay.
If the application is approved, they'll also clearly outline any specific conditions or stipulations attached to that grant of automatic authority.
Conditions? Like what?
Could be various things, but it's also important to understand the VA generally expects lenders with automatic authority to use it as much as possible.
Right.
If a lender submits a loan for prior approval that doesn't fall into one of those mandatory categories, their VA-approved underwriter usually has to provide a written explanation for why they chose that route.
Okay, so they can't just default back to prior approval easily, even if they have automatic authority. Now, I also saw something about a probationary period, specifically for new non-supervised automatic lenders. Can you tell me about that? How does that work?
Yes, that's standard practice. New non-supervised automatic lenders are typically placed on a probationary period, often a year, maybe longer.
And during probation?
During this time, the VA offices getting their loans will very closely monitor their performance. They look at the quality of their underwriting, the completeness of their submissions, how well they follow VA rules, even their loan delinquency and foreclosure rates.
How do they monitor that closely?
Well, they conduct a full comprehensive review, including a detailed underwriting analysis of at least the first 15 loans the new lender closes and guarantees automatically.
15 full reviews right off the bat.
Yep. And after that, they typically review 50% of the next 50 loans. And it's important to know, the VA can withdraw their automatic authority during this probation if they see patterns of poor underwriting or consistently careless processing.
So probation isn't guaranteed success?
Not at all. At the end of the probationary period, the VA formally notifies the lender in writing about the outcome, whether probation is terminated successfully, maybe extended, or in some cases, they might even revoke the automatic authority altogether.
So this probationary period acts as a crucial safeguard, letting the VA assess real-world performance before fully trusting them with automatic authority.
Exactly. It's a real-world test drive, essentially.
That sounds like a really robust system for vetting and then monitoring these non-supervised lenders. Now, once a non-supervised lender has automatic authority, it seems they have to formally agree to certain certifications. What are the key promises they're making?
These certifications, which the president or a principal officer has to sign off on via that VA form 268736, are basically their binding commitments to operate strictly according to VA guidelines.
Okay. What are some big ones?
One really important one is that the lender will not use their automatic closing authority just as a convenience or favor for other mortgage lenders who don't have it themselves.
No piggybacking.
Right. They also certify they won't automatically close loans for affiliated entities like builders they have a financial tie to without getting express written VA approval first.
Any exceptions there?
Yes, there's a specific exception for permanent mortgages that directly follow their own VA-approved construction loans. Additionally, they'll promptly notify the VA of any significant changes in their corporate structure, operations, or financial condition that could affect their eligibility for automatic authority.
So transparency about major changes is key.
Absolutely. These certifications really underscore the VA's focus on keeping the program fair and maintaining its integrity.
And what happens if a non-supervised automatic lender finds they no longer meet a basic qualification, like maybe their working capital dips below the required level?
If that happens, and it wasn't due to an ownership change, the lender has to quickly submit a detailed plan to the VA.
A plan for what?
A plan outlining the specific steps they'll take and the timeline for fixing the deficiency and getting back into compliance. Generally, they might be allowed to continue closing automatically while the VA reviews their plan. But there's a critical exception. If at any point they no longer have a VA-approved underwriter on staff, they must immediately stop all automatic loan closings until they get a qualified and VA-approved underwriter back in place.
Wow. So the underwriter is absolutely non-negotiable for automatic closing.
It highlights just how essential that role is to the integrity of the automatic process.
Makes perfect sense. You need that qualified gatekeeper. What about more fundamental changes, like the lender's ownership changing or even just a legal name change?
They have to formally notify the VA of any such changes through the RLC of the surviving entity. And it's particularly important to understand that any merger or acquisition involving a non-supervised automatic lender generally terminates their automatic authority.
Terminates it completely.
Usually, yes. Unless the resulting new entity itself independently qualifies as a supervised lender right from the start. We'll dig into the specifics of mergers and acquisitions a bit more later.
Okay, so those are key operational certifications. What about the actual process of underwriting the VA loans closed automatically? Any certifications tied to that?
Yes, they must certify that every single VA loan they close automatically will be thoroughly reviewed and formally approved or rejected by a VA-approved underwriter.
And that underwriter needs to know their stuff.
Absolutely. They certify the underwriter has a comprehensive understanding of the VA Lender's Handbook, especially the chapter on credit underwriting standards. Insurance decisions are made by qualified pros who know the VA's specific requirements.
So it really all comes back to those qualified VA-approved underwriters. Are there ongoing financial certifications required for these non-supervised automatic lenders?
Yes, they have to submit annual financial statements to the VA.
Okay.
These statements must be audited and formally certified by an independent CPA and sent to the relevant RLC within 120 days after their fiscal year ends.
And what do these financials need to show?
They need to clearly demonstrate that the lender continues to maintain either a minimum of $50,000 in working capital or at least $250,000 in adjusted net worth, calculated according to the VA's specific rules.
So ongoing proof of financial stability.
Exactly. Helps ensure the lenders in the program remain financially sound.
And what other important info usually needs to go along with these annual financial statements when they're sent to the VA?
Along with the audited financials, they also need to submit a list of any VA-recognized agent relationships they want to renew for the next year if they use agents.
Right, the agent renewals again?
Yep, and the payment for the associated annual fees. And of course, they have to provide any other relevant info the VA might specifically request for their annual recertification. It's the lender's job to get this in accurately and on time.
So it's definitely not just a one-time approval to become an automatic lender. There's continuous monitoring and important annual hoops to jump through.
That's right. It's an ongoing commitment.
Are there any other general certifications they make when they first sign that application form for automatic authority?
Yes, a few others. They also formally certify they'll fully comply with all VA regulations, directives, and laws. that they'll let the VA examine their relevant records anytime that's reasonable, that they'll provide any info the VA asks for related to the program.
Standard stuff.
Pretty standard compliance stuff. And, importantly, that they will actively use their automatic authority as much as possible and provide a clear, justifiable explanation anytime they process a loan through prior approval instead.
Okay. It truly sounds like the VA has a very comprehensive set of rules and ongoing requirements for non-supervised lenders who get the privilege of automatic authority. Now, let's dig into the specifics of how these lenders actually get their individual underwriters approved by the VA, and also the process for closing VA loans involving an affiliate of the lender.
Right. When it comes to underwriter approval, like we touched on, all VA loans closed automatically by a non-supervised lender must be reviewed and formally approved, rejected by a VA-approved underwriter.
And they have to sign off.
Yes. That approved underwriter has to sign VA Form 266393, the loan analysis form, for each loan file. An electronic signature is fine nowadays.
Okay. And if a lender wants to get more underwriters approved later on, after they already have automatic authority?
They need to submit a formal request to the VA office overseeing their home office, along with the required processing fee. They also need to provide the same detailed documentation for each new underwriter nominee as they did for their initial ones.
Same qualifications apply.
Same qualifications, yes. And again, it's crucial these underwriters are thoroughly familiar with VA's credit standards and the lender's handbook.
And there's that mandatory training component for these underwriters, right?
Yes, absolutely. All newly approved underwriters, and also those who haven't actively underwritten VA loans in the last 24 months, have to successfully complete a one-day, 8-hour comprehensive training course.
What does the training cover?
It covers their specific responsibilities as a VA underwriter, all the relevant VA underwriting requirements, and the necessary administrative procedures, including how to use all the required VA forms correctly.
And they have a deadline.
Yes, it must be completed within 90 days of the underwriter's approval. The VA also offers a convenient web-based version through their Veterans Information Portal, VIP. Completing that online course works too.
Okay.
And it's worth noting, underwriters who consistently approve loans that don't meet VA standards might even be required to retake the training.
So continuous learning and adherence are clearly emphasized. What happens if a VA-approved underwriter, leaves the lender, quits, or gets fired?
In that case, their VA approval is automatically terminated.
Yeah.
The VA doesn't need to send a formal notice or anything.
But the lender has to do something.
Yes, the lender has a clear responsibility to promptly report the underwriter's departure to the VA. And crucially, they cannot continue closing VA loans automatically without having at least one currently VA-approved underwriter on staff.
Reinforces again how essential that role is for automatic authority.
Exactly.
Okay, now what about closing loans involving affiliates like a related real estate brokerage or builder? Is there a special process for getting VA approval to do those automatically?
Yes, a non-supervised automatic lender needs specific written approval from the VA if they want to close loans involving their affiliates on an automatic basis. Affiliates meaning, a real estate brokerage, a builder, a developer, where there's a shared financial interest, ownership, or some formal affiliation.
And they can ask for this approval anytime?
Yes, they can request it either when they initially apply for automatic authority or anytime later as their business relationships change.
What kind of specific info and documents does the VA need when a lender asks for this affiliate approval?
They need formal corporate resolutions from both the lender and each affiliate involved.
Okay. What do those resolutions need to say?
They need to explicitly state that the lender and each affiliate are separate legal entities and operate independently in all aspects of their business.
Right.
The lender's resolution must also clearly confirm they won't give any preferential underwriting treatment or better loan terms just because it involves an affiliate.
And the affiliate's resolution?
Similarly, the affiliate's resolution must confirm they won't try to influence or pressure the lender for favorable underwriting or terms.
So promises of independence from both sides. Anything else?
Yes. The lender also needs to submit formal letters from their permanent investors.
Investors, what do they need to provide?
These letters need to disclose the delinquency ratio specifically, the percentage of VA loans the lender originated based on the affiliate's referrals or production that are 90 days or more past due over the last year.
Okay, delinquency stats on affiliate loans.
Right. And that delinquency rate must not exceed the national average for all mortgage loans during the same period.
Wow. So the VA is really checking the performance of those affiliate-generated loans.
They are. This detailed info helps the VA assess if there's any undue risk or potential for conflicts of interest in these affiliated transactions. They're being very diligent.
Absolutely seems like it. Preventing conflicts and ensuring fair underwriting, even with affiliates. Now, let's move on to that important relationship between lenders and the agents they use. How does a supervised lender or a non-supervised automatic lender formally request VA recognition of an agent they work with regularly?
Okay. For any lender with automatic authority, supervised or non-supervised, if they plan to use an agent, mainly meaning a mortgage broker, on an ongoing basis, they absolutely must formally request and get VA recognition of that specific relationship.
And the VA is pretty strict about lender responsibility here, right?
Unequivocally clear. The lender bears full and complete responsibility for all actions, errors, or omissions of their agents in processing and closing VA loans.
How is that formalized?
It's certified by the lender on VA Form 26/1820 and also stated in the lender's corporate resolution. And importantly, the lender can't later say, oh, it wasn't our fault, we relied on the agent.
No excuses.
Nope. Any irregularities from the agent's involvement are treated as the lender's responsibility. And the VA can take action against both the lender and the agent if needed.
Really highlights the need for lenders to pick and oversee their agents very carefully.
Extremely important.
And for non-supervised automatic lenders, if an agent originates a loan that gets closed automatically, it still needs that final review and approval by the lender's own VA-approved underwriter, correct?
Absolutely correct. Even if a recognized agent does a lot of the initial legwork, the sponsoring non-supervised automatic lender's own VA-approved underwriter must still conduct a full review and formally approve the loan file before it closes automatically.
And that approval needs to be documented.
Yes. Clearly evidenced by the underwriter's signature on VA Form 26/6393. It's a dual layer of oversight when agents are involved with non-supervised automatic lenders.
Okay, so what are the specific steps to request VA recognition for an individual agent?
The lender submits a formal written request to the relevant VA office. This request needs a certified copy of the lender's corporate resolution.
And that resolution needs specific agent details.
Yes, the agent's full legal name, business address, contact info, federal tax ID number. It also needs to clearly state the exact functions the agent is authorized to perform for the lender in the VA loan process.
And the responsibility part.
Crucially, yes. The resolution must include that explicit statement from the lender accepting full responsibility for the agent's actions. Also, if the agent can lock rates on the lender's behalf, that needs to be stated too.
Okay. Any fees?
Yes, a non-refundable $100 processing fee per agent must come with the request. And the lender can only start using the agent for VA loans after getting written confirmation of VA recognition.
And the agent needs to be identified on the loan paperwork.
Yes, for each individual loan the agent is involved in, both the agent and their specific function must be clearly identified on VA Form 26/1820. It's a detailed process to ensure VA knows who's acting for whom.
So formal request, specific info, corporate resolution, fee, and wait for approval. What if a lender uses a lot of agents? Is there a more streamlined way than doing that whole resolution every time?
Yes. For lenders using many agents regularly, the VA offers a blanket corporate resolution option.
How does that work?
This type of resolution outlines the general functions all their agents will perform, includes the standard lender responsibility statement, says if they'll honor agent rate locks, and identifies the lender officers authorized to request and remove agent recognition under this blanket rule.
Does that mean they don't need individual requests anymore?
No, unfortunately not entirely.
Right.
Even with a blanket resolution, the lender still has to submit an individual recognition request with a $100 fee for each new agent they want to use. Those individual requests just reference the adoption date of the blanket resolution and include the specific agent's details. And again, they have to wait for VA recognition before using that agent.
So the blanket resolution simplifies some initial paperwork, but doesn't skip the individual agent recognition step or fee.
Correct. Streamlines part of it, but not all.
Now, you mentioned VA Form 26/1820 again.
Yeah.
How exactly does the lender fill that out, depending on who actually funds the loan at closing, the lender or the agent?
Okay, good question. If the lender directly funds the loan at closing, or if the agent closes, but the lender simultaneously buys and funds it, sometimes called table funding, then the lender's VA ID goes in item 2B.
Okay.
And the agent's name and function go in item 24J. The sponsoring lender then completes items 25 and 26.
Got it. What if the agent funds it in their own name first?
Right. If the loan is actually closed and funded in the agent's own legal name under an agreement with the lender, then the agent's VA ID number goes in item 2B.
Okay.
Their name and function still go in 24J. But in this case, item 25A should show the agent's name, then the phrase agent for, and then the sponsoring lender's full name plus the agent's address. The agent then completes items 25 and 26.
So the form clearly reflects who's providing the funds. What about the VA loan summary sheet, form 260286? Does agent info go there too?
Yes, that form has specific spots for both the lender's VA ID and the agent's VA ID, if an agent was involved. Both ID numbers should always be accurately entered whenever a VA-recognized agent performed any function on that loan. Creates a clear record.
And who gets the official loan guarantee certificate, LGC, once the loan is guaranteed? Lender or agent?
The LGC is always issued directly to the sponsoring lender through the VA's online WebLGY system. Even if an agent did most of the work, the guarantee is ultimately between the VA and the lending institution.
Okay, lender remains the primary entity for the guarantee. Now, can a recognized agent actually close loans automatically on behalf of an automatic lender?
Yes, if the sponsoring lender has automatic authority, their formally recognized agent is also authorized to close VA loans automatically on their behalf.
To the same extent as the lender?
Pretty much, yeah. As long as all the VA requirements for agent recognition and reporting on Form 26/1820 are met. But remember,
What's the catch?
for non-supervised automatic lenders using agents, any loan closed automatically by their agent still requires that thorough review and formal approval by the lender's own VA-approved underwriter, documented on Form 266393.
Right, that underwriter check is still vital for non-supervised lenders. So the agent's automatic ability is tied to the lenders, and the underwriter review is key. What about lenders who don't have automatic authority? Can they use agents at all?
No. Lenders without automatic authority are specifically prohibited from using agents to originate VA loans.
Okay.
They have to follow the prior approval procedures detailed in Chapter 5 for every single VA loan they originate.
So if you can't close automatically yourself, you can't have an agent do it for you. Makes sense.
Exactly. Reinforces that principle.
Okay, let's circle back now to those mergers and acquisitions we mentioned earlier. How do these big corporate changes typically affect the VA status of a supervised or non-supervised automatic lender?
Right. Any significant change in a lender's ownership or structure can definitely impact their continued eligibility for automatic authority. So it's absolutely essential the VA is notified promptly whenever a merger, acquisition, or any ownership change happens.
Why the urgency?
This notification lets the VA evaluate any potential impact the changes might have on the lender's ability to keep participating in the VA program according to the rules. And this isn't just formal M&A. It includes any restructuring that significantly alters ownership, structure, or core assets. VA needs the heads up.
So any major shakeup needs reporting. What specific information does a supervised or non-supervised automatic lender need to send the VA when one of these deals happens?
They need to submit a processing fee, currently $100, along with several key pieces of info to their RLC.
Like what?
The full legal names of all entities involved acquiring, selling, surviving. The surviving entity's general info, like corporate address, owners, officers. A general overview of the assets being acquired.
Okay.
Complete addresses and VA ID numbers for all their VA lending branch offices, and whether each branch will continue operating. Plus, a detailed list of all agents with VA IDs the surviving entity plans to use who are previously recognized for the selling or acquiring entities.
Can they request new agent recognition at the same time?
Yes. They can include requests for new agents too, provided they submit the required fees and corporate resolutions for those. And if any info hasn't changed, they don't need to resubmit it, just say it's the same.
Sounds like a lot to track.
It can be. Lenders should always check with their RLC if they have questions, as each situation can be unique and the VA might ask for more info case by case.
Okay. Are there any additional specific things that non-supervised automatic lenders have to submit in these M&A situations?
Yes, on top of the general requirements, non-supervised automatic lenders have extra items. They need detailed resumes for all new owners or principal officers of the surviving entity, focusing on their mortgage lending experience.
Checking the new leadership's background.
Exactly. They also need to submit a list of all underwriters the surviving entity will employ who were previously VA approved for any of the merging entities. And, like with agents, they can submit requests for approval of new underwriter nominees then too, with the standard fees and application materials.
So the VA pays extra close attention to the leadership and underwriting staff when non-supervised lenders merge or get acquired.
Reflects that greater level of direct VA oversight over them, yes.
What about lenders in the Lender Appraising Processing Program, LAPP? Any extra steps for them during M&A?
Yes, LAPP lenders have additional things too. They need to provide a list of their LAPP staff appraisal reviewers, or SARs, who will be employed by the surviving entity and were previously approved for any merging entity.
Needs SAR IDs and proof of training.
Yes, SAR IDs and copies of VA letters confirming they met training and case review requirements. Also, if Azea's previous employer had a different name, the surviving lender needs to submit a new SAR application and lender certifications for them.
Okay.
They also need to list any SARs from previous entities who won't be employed by the survivor. And again, they can submit requests for approval of new SAR applicants at this time with the usual materials.
So lots of personnel tracking for non-supervised and LAPP lenders during mergers. Now, what's the immediate impact on a lender's automatic authority while the VA is reviewing all this submitted paperwork? Does everything stop?
This is a really crucial point, and the impact differs. For a non-supervised automatic lender, any change in ownership always results in the immediate extinguishment of their existing automatic and LAPP authority.
Always, unless
the newly formed entity independently qualifies as supervised right from the start. That's a huge consideration for non-supervised lenders planning ownership changes.
Wow. What about supervised lenders merging?
When a supervised lender merges or is acquired, the VA uses the same initial criteria for supervised status to see if the surviving entity still meets that definition.
Okay, so ownership change is a massive trigger for non-supervised lenders. Can you give some specific examples of M&A scenarios and their immediate impact on automatic authority?
Sure. Let's say a supervised lender, or maybe a mix of supervised and non-supervised automatic, merge into a new entity that clearly appears to be supervised by one of those key federal regulators like the FDIC.
Yeah.
Then typically no extra submissions are needed right away, and their automatic authority just continues uninterrupted.
Okay, smooth transition. If supervision is clear, what if it's less clear?
Okay, scenario 2. At least one merging entity was supervised, and the new entity appears supervised, but its status isn't immediately obvious to the VA and needs formal recognition under Section 3. Then the survivor needs to submit that formal request for recognition with all the Section 3 info. If the source and nature of supervision are the same as before, automatic authority usually continues. But if the supervision source changed, then all VA loans likely need prior approval until the VA decides on the new entity's supervised status.
So uncertainty about supervision defaults to prior approval. Prudent. What about a scenario where only non-supervised automatic lenders merge and the new entity looks supervised but needs VA recognition?
In that case, the new entity has to submit the request for VA recognition as supervised with all the Section 3 documents. And in the meantime, all their VA loans require prior approval until the VA makes a formal decision.
Okay, prior approval is the default again, while that new supervised status is reviewed. Now, what if a non-supervised automatic lender with different ownership merges into another non-supervised lender, or even a supervised one, but the resulting surviving entity is still non-supervised?
Right. In this situation, if the surviving non-supervised lender wants automatic authority, they typically have to submit a completely new application for automatic authority to the VA with the full fee.
And in the meantime,
their previous automatic authority is immediately extinguished. All VA loans require prior approval until the VA decides on their new application. Really shows how important ownership continuity is for non-supervised automatic lenders.
That sounds like it could cause a major disruption. What if it's a merger between two or more non-supervised automatic lenders, but the ultimate ownership stays substantially the same in the surviving non-supervised entity?
In that specific scenario, no additional submissions are needed immediately. Their existing automatic authority generally continues without interruption, provided the surviving lender keeps its previously VA-approved underwriter.
So, continuity of both ownership and underwriters is key there.
Exactly. Those are the key factors for maintaining automatic authority in those specific non-supervised mergers.
It's a complex web, all right, but definitely seems designed to ensure only fully qualified and overseen lenders get and keep automatic authority. Now, what happens if a lender, supervised or non-supervised automatic, starts, falling short or breaking the rules? What's the process for withdrawal of automatic authority?
The VA definitely has the authority to withdraw a lender's automatic authority if they find proper cause. They have to give the lender formal written notice at least 30 days ahead.
And this applies to both types?
Yes, both supervised and non-supervised. It's outlined in the regulations. Even after withdrawal, the lender can still process VA loans, but they'd have to do it strictly on a prior approval basis.
Okay. What reasons could lead to an indefinite withdrawal, like getting kicked out permanently?
An indefinite withdrawal can happen if a lender stops meeting the basic qualifying criteria. For supervised lenders, that could mean losing their supervised status from the regulator.
Right.
For non-supervised lenders, it could be things like no longer having a VA-approved underwriter, failing to maintain the required working capital or net worth, or failing to file their required annual financial statements on time.
So failing the basic requirements. Anything else?
Yes, any of the specific causes for debarment listed in VA regulations could also lead to indefinite withdrawal. And for new non-supervised lenders during probation, things like really poor underwriting, consistently careless processing, or failing to provide loan files or documents when asked can also result in indefinite withdrawal.
Those all sound like pretty serious failures or breaches of trust. What about withdrawals for a specific fixed period, like 60 days? What triggers that?
A 60-day withdrawal might happen if a lender's loan submissions consistently show repeated significant underwriting problems even after the VA has warned them multiple times.
Like what kind of problems?
Maybe repeatedly qualifying borrowers with unstable income or constantly ignoring major adverse credit history. Another cause could be improperly handling employment or deposit verifications, like letting applicants hand carry those sensitive docs. Same penalty could apply for submitting consistently incomplete loan packages after repeated warnings, or just continued disregard of VA requirements despite multiple notifications. These are meant to get lenders to quickly fix procedural issues.
So, focused on repeated failures to follow procedures and guidelines. What about longer temporary withdrawals, say 180 days? What more serious issues lead to that?
A 180-day withdrawal can occur if the VA finds the loans a lender submits clearly conflict with VA credit standards loans a prudent lender just wouldn't make. Another serious cause is failing to disclose significant debts or other material info that affects the veteran's ability to repay, putting the government at undue risk.
Misleading the VA, essentially.
Yes. Similarly, if improper handling of verifications results in significant misinformation being sent to the VA. And finally, the VA takes substantiated complaints very seriously.
Complaints from veterans?
Yes, complaints showing a lender misrepresented VA requirements to a veteran's detriment. Examples: maybe wrongly advising a vet against a lower rate, improperly charging fees and not refunding them after VA notification, or deliberately delaying closings unreasonably. These indicate bigger concerns about judgment and ethics.
Those examples really show the VA's concern for protecting veterans. Now, what about even longer withdrawal periods, like 1 to 3 years? What are the most serious offenses that trigger that kind of suspension?
Withdrawals for 1 to 3 years are for the most severe violations. Things like failing to properly disperse loan funds after closing, maybe checks bounce repeatedly due to insufficient funds. Another very serious one is lender involvement in the improper use of a veteran's entitlement, like knowingly letting a vet violate the occupancy rules.
Right.
And finally, a lender's direct involvement in a scheme where a vet improperly sells their entitlement to someone else, like making a loan knowing the vet won't occupy and will transfer title right after closing. That's a major violation.
So outright fraud or serious abuse of the program.
Exactly. These extended withdrawals show the VA's absolute commitment to preventing that.
These longer periods definitely emphasize the VA's commitment. It's clear they take this very seriously. Now, let's talk about the participation fees associated with being a supervised or non-supervised automatic lender. Sounds like there are costs involved.
Yes, the VA is authorized to collect fees from lenders with automatic authority to help cover the admin costs of running the VA home loan program. All fees go to the relevant RLC, paid by lender's check to the Department of Veterans Affairs, and they're generally non-refundable. Also, if a lender hires an agent, underwriter, or SAR who was previously approved somewhere else, the new lender usually has to pay the fee for a new recognition or approval for that person with them.
So no free rise for previously approved staff moving over. What are the specific annual fees for non-supervised automatic lenders?
Okay, non-supervised automatic lenders pay their annual fees within 120 days after their fiscal year ends. Along with the payment, they need that list of agent relationships they want to renew if they use agents.
And the fees are?
A $200 annual recertification fee for the lender itself, plus $100 for the annual renewal of each agent recognized as their agent at the end of the last fiscal year.
Is there an exception for newly recognized agents?
Yes, no annual renewal fee for an agent if their VA recognition letter was issued within the last quarter of the lender's fiscal year.
Okay. What about the initial application fee?
There's a $500 fee for processing an initial application for automatic authority. This $500 includes reviewing any underwriter nominees submitted at the same time. But it does not include simultaneous agent recognition requests. Those are still an extra $100 per agent.
Okay, so both the lender and their agents have annual fees. What about other specific administrative actions a non-supervised lender might need? Fees for those too?
Yes, there are other admin fees they pay when they submit requests. For example, $100 to process each individual underwriter nominee approval request, though this is waived if it's submitted with the initial automatic authority application.
Okay.
There's also $100 to process each agent recognition request. If their automatic authority lapsed or was terminated and they want it reinstated, that's a $200 fee.
And for other miscellaneous things, like merger reviews?
For other VA admin actions related to automatic lending, like merger submissions, there's a minimum fee of $100 per request. The VA will let them know if the fee for a specific action is higher than that minimum. These cover the VA's time and resources.
So fees for initial application and various ongoing admin tasks. What about supervised lenders? Same fee structure.
Supervised lenders have a somewhat different, simpler structure. They only pay annual fees if they have agency relationships.
Okay.
Those annual fees are due by January 31st each year, based on the previous calendar year's agents, along with a list of renewals. The fee is $100 for each agent recognized during the previous calendar year.
Same exception for recently recognized agents.
Yes, same exception. No renewal fee if the agent's recognition letter was from the last quarter of the calendar year. This reflects the VA relying more on their primary supervision.
And what about specific administrative fees for supervised lenders besides agent renewals?
The main admin fee for supervised lenders is just that $100 fee for processing each individual request for VA recognition of an agent paid when the request is submitted.
So definitely some differences, with non-supervised lenders having more upfront and annual recertification fees for their automatic authority. And finally, I see a quick mention of fees for the Lender Appraising Processing Program, LAPP.
Yes, for LAPP participants, there's a one-time, non-refundable $100 fee for each individual applying to be a VA staff appraisal reviewer, or SAR. This fee applies even if they aren't approved.
And if an approved SAR moves to a new lender,
the new employing lender also has to pay a new, separate $100 application fee for that SAR to be approved under their sponsorship. Chapter 15 of the handbook has more details on LAPP.
So it looks like the VA has a pretty comprehensive fee system to help manage the costs of this vital program. Now, once a lender is approved and making VA loans, they have an ongoing responsibility for maintenance of loan records, right? Keeping the paperwork.
Absolutely critical. All lenders in the VA program must maintain a complete and accurate record of all loan origination activities for every VA guaranteed loan they originate.
For how long?
For a minimum period of at least 2 full years from the date the loan officially closes.
Even if they sell the loan?
Yes, even if they sell the loan, the originating lender is still obligated to maintain these records or clear copies for the entire 2 years. Ensures a full audit trail exists.
What specific kinds of documents are we talking about here? What's in the loan origination records?
It's pretty extensive, capturing the whole process.
Right.
Includes the initial loan application, any preliminary apps or questionnaires, all employment and deposit verifications.
Okay.
Every credit report obtained, copies of the sales contract and any addendums, any letters of explanation from the borrower, creditor references, employer correspondence.
Appraisal reports, too.
Yep. All appraisal and compliance inspection reports, termite or other property inspection reports, builder change orders for new construction, and finally, all the final closing papers and loan documents executed at closing. It's comprehensive.
So basically the entire paper trail from start to finish. And these records need to be easily accessible to the VA if they need to see them.
Yes, absolutely essential. They must be maintained so authorized VA personnel can readily access them for audits or program oversight. Lenders have to be ready to provide them promptly upon request.
Okay, so not just kept, but organized and available. Now, the VA also provides resources under lender access to training and information. What kind of training and info is available?
The VA's regional loan centers in the Honolulu office conduct regular training sessions for lenders and others in their areas.
In person?
Often, yes. The VA strongly encourages every lender to have at least one representative attend a session annually, maybe more if needed. Lenders can also talk to their RLC about any specific or unique training needs their staff might have.
So live training is an option. What about online or web-based training?
Yes, the VA also offers a range of interactive web-based training sessions. A really important one is the Hometown USA Credit Standards Training, available through the VA's Veterans Information Portal, VIP.
Okay.
Plus, there are numerous other loan guarantee training resources right on the official VA home loan website. Provides flexibility for lenders.
Sounds like the VA tries to offer multiple ways for lenders to stay trained and informed. What about the key documents themselves, like the lender's handbook we've been using? Where are those?
All the essential docs, the handbook, the servicing guide, official VA circulars announcing policy changes, lots of other critical info are all available electronically on the official VA home loan website.
Easy to find.
Yeah, there are dedicated sections for lenders, servicers, and real estate pros. This central online spot ensures everyone has access to the most current, accurate info.
So pretty much everything a lender needs is online, which should help them stay current. Is there anything else lenders need to do proactively to make sure they get important communications from the VA?
Yes, it's absolutely crucial they promptly inform the appropriate VA office of any changes in their primary point of contact, their official mailing address, or their primary email contact.
Why is that so critical?
Because the VA routinely sends out important mailings, updates, critical communications to the address linked to the lender's VA ID number. Keeping that contact info current is vital to get necessary info on time.
Makes perfect sense. And if a lender has specific questions they can't find answers to online, or needs to discuss a particular loan scenario, who do they call?
Best bet is to reach out directly to the regional loan center that has jurisdiction over their main home office. RLC staff are the primary contact for questions not in the handbook or for detailed discussions about individual loans or requirements.
Is there an escalation process?
Yes. The VA also has a formal escalation protocol for resolving more complex policy issues or disputes. Info on how to use that is usually on the VA website too. These direct lines are essential for lenders.
So multiple channels for info and support. Now, we briefly touched on the calculation of adjusted net worth for non-supervised lenders earlier. Sounds like a very specific calculation that excludes certain assets.
Yes, the VA has a very specific definition of adjusted net worth for their financial requirements for non-supervised automatic lenders, outlined in their regulations.
And who does the calculation?
It must be done by a qualified CPA using figures from the lender's latest audited and certified balance sheet. Ensures consistency and objectivity.
And what are some key categories of these unacceptable assets that get subtracted to arrive at the VA's adjusted net worth figure?
There are several specific types. Any assets the lender has pledged to secure someone else's obligations are out.
Okay.
Amounts due to the lender from their own officers or stockholders or related entities where those individuals have a personal financial interest unrelated to their job.
Right, potential conflicts there.
Also, investments the lender holds in related entities where officers, stockholders, or their families have a personal interest unrelated to their professional roles.
More potential conflicts.
Exactly. Also, the portion of investments in joint ventures, subsidiaries, etc., that exceeds the lender's actual equity in them after adjusting for their unacceptable assets.
Gets complicated.
It does. Also excluded are essentially all intangible assets, goodwill, covenants not to compete unless they're unamortized servicing costs from an arm's length deal and follow GAAP rules. They also have to adjust the value of non-readily marketable assets with subjective appraisals, think antiques, art carrying them at a substantially discounted value or lower of cost or market. And finally, any assets mainly for personal enjoyment of officer stockholders, not for normal business operations.
So things like company jets for personal use.
Potentially, yeah, if not primarily for business. This whole detailed list ensures a more conservative, realistic assessment of the lender's true financial standing.
A very specific list of exclusions indeed. Seems the VA wants a very clear, conservative picture of a non-supervised lender's real financial strength. Now, the final major topic, elements of a quality control plan. Sounds like a crucial component, especially for non-supervised lenders seeking automatic authority.
Absolutely. A comprehensive quality control QC plan is a mandatory submission with every initial application from a non-supervised lender seeking automatic authority.
Do supervised lenders need one too?
They aren't typically required to submit one initially, but the VA will review their existing QC procedures during routine lender audits. This QC plan is basically the blueprint for how the lender ensures ongoing compliance with all VA loan processing and underwriting rules. It's critical.
What are the key elements the VA looks for in a lender's QC plan? What makes a good one?
One fundamental element is the audit program. The plan needs to clearly describe either a robust internal or external audit program the lender will use to regularly check their compliance with VA rules, or alternatively, they can outline a process for independent review done by knowledgeable managers within the company who don't have direct processing or underwriting responsibilities. Ensures objectivity.
So, a formal, ongoing system for checking their own work. What about the adequate scope of these audits? How often and how thoroughly do they need to be?
The plan must show the audit program will cover at least 10% of all VA mortgages they originate monthly, including loans from all branches and agents.
10% across the board.
Usually. But for very high volume lenders, over 140 VA loans a month, the VA might allow statistically valid sampling instead. Either way, the reviews must include loans from all loan officers and underwriters, and use random selection covering all branches and agents.
What if they find fraud or big problems?
The plan needs clear procedures for expanding the review scope if fraud or significant deficiencies are found. For LAPP lenders, it must include specific LAPP QC procedures. It also needs procedures for validating third-party data from automated underwriting systems. And for every branch office originating VA loans, the plan must commit to a thorough on-site review of that branch at least once a year. It's a comprehensive scope.
That sounds like pretty rigorous internal oversight. What about how the findings of these audits are handled internally?
The QC plan must include a clear process for written notification of all deficiencies found during audits or reviews directly to the lender's senior management, at least quarterly.
And then what?
Then, senior management is expected to take prompt and effective corrective action on all identified issues, whether found internally or by the VA. The plan must outline how they'll document deficiencies, the corrective actions taken, and how corrective instructions get to relevant employees, especially if patterns emerge. Timely, effective fixes are key.
So not just finding problems, but fixing them fast and preventing repeats. Any requirements for reporting findings to the VA?
Yes, the plan must state the lender has a responsibility to promptly report any suspected or confirmed violation of law or regulation, any false statements, or any other program abuse by the lender, employees, or others directly to the relevant VA office.
So self-reporting is mandatory.
Yes, and they must agree to give the VA copies of their audit findings upon demand. This transparency is crucial.
Got it. What about staying current with the VA's changing rules and procedures?
The QC plan needs to ensure the lender's own internal procedures are revised promptly and accurately to reflect all VA changes. Plus, all lender offices, including agents and branches, must maintain current copies of all relevant VA publications, regs, handbook releases.
And staff need access?
Yes, accessible to all employees involved in VA lending and periodically reviewed with staff so everyone's using current guidance.
All about ongoing compliance and keeping everyone informed. Any restrictions in the QC plan about who can actually process VA loans?
Yes. The plan must state that all loan submissions to the VA for guarantee must be processed only by direct employees of the lender or by their officially authorized VA-recognized agents. Helps prevent unauthorized third parties getting involved.
Important safeguard. What about VA funding fees? Does the QC plan cover that?
Yes, it must include procedures to ensure all required VA funding fees are accurately calculated and sent to the VA within 15 calendar days of closing. And it must address promptly submitting any late charges or penalties if a payment is delayed. Timely, accurate fee payment is critical.
So paying fees on time is part of quality control too. What about managing borrower escrow funds?
The QC plan must include provisions ensuring any escrow funds received from VA borrowers aren't excessive and are used only for their intended appropriate purposes, following the loan agreement and VA rules. Proper fund management is key.
Responsible handling of borrower money is crucial. Any restrictions on who lenders can employ in VA loan roles?
Yes, the QC plan must specifically ensure the lender doesn't employ or engage anyone formally debarred or suspended by any federal agency from participating in VA loan origination, underwriting, or servicing. Protects the program from bad actors.
Very important safeguard. Finally, there's a section in the QC requirements about the review of loans. What does that involve?
The QC plan needs to outline a process for the lender to do a thorough post-closing review of a selected sample of their VA guaranteed loans within 90 days after closing.
What happens in this review?
It includes written re-verification of the borrower's current employment, deposits, and all fund sources used for closing. It also requires the lender to reorder a completely new credit report from a different agency than used initially, like an RMCR or a 3-file merge.
Okay. And what does the reviewer check?
The reviewer determines the overall completeness and accuracy of the initial underwriting conclusions and documents based on a detailed checklist.
What kinds of things are on that checklist? It sounds thorough.
It is very thorough. They check if the file has all required VA docs, if everything was properly signed and initialed, if verifications and credit reports were handled correctly and not passed through the borrower,
Okay.
if credit reports meet VA standards, if there's a logical link between applied versus verified assets liabilities, if judgments were handled properly, if tax returns are there.
And closing disclosure accuracy, too.
Yes. Accuracy of the closing disclosure, appropriateness of all fees charged to the vet, if the loan was properly documented per VA standards, if it was current when submitted for guarantee, if property transfer happened correctly, and crucially, if any conflicting info or discrepancies found during processing were properly resolved and documented before VA submission. It's a systematic post-closing QC process.
Incredibly detailed, covering everything from start to finish and beyond, really underscores the VA's commitment to quality, accuracy, and compliance. Finally, topic 15, the application checklist for authority to close loans on an automatic basis. Sounds like a helpful summary of everything we've discussed.
Exactly. It's an extremely useful summary of all the crucial criteria and required documents for non-supervised lenders seeking automatic authority.
What does it cover again, quickly?
It concisely outlines the experience requirements, company, officer, or agent paths, underwriter qualifications, experience or certification, financial requirements, working capital or net worth, the need for audited financials, line of credit, permanent investors, the QC plan itself.
Liaison officer, affiliates.
Yep. Designating a liaison officer, submitting resolutions data for affiliates, providing info on branches or agents, and a final reminder about submitting the application fee. It's an invaluable final check for lenders before they submit.
Well, this has been an incredibly comprehensive and really insightful deep dive into the VA's lender approval guidelines. It's abundantly clear the VA has a very thorough, multifaceted system to ensure only qualified and responsible lenders provide these vital home loans to our veterans.
Absolutely. We've covered a lot, the key definitions, the differences between lender types, the detailed processes for getting and keeping automatic authority, lender responsibility for agents, the impact of mergers, reasons for withdrawal, the fees, record-keeping training, net worth calculation, and those crucial QC plan elements. It really shows the high level of oversight the VA maintains.
And when you really think about this level of scrutiny, these, pretty stringent requirements, it really makes you consider the VA's deep commitment to protecting veterans in the home loan process, doesn't it?
It really does.
It also makes you wonder, maybe, how these demanding regulations might shape the landscape of lenders who are actually able and willing to make the effort to offer VA loans. It's definitely something to think about.
Indeed. We'd certainly encourage you, the listener, to think about the implications of these guidelines. Maybe dig deeper into any areas that particularly caught your interest today. Understanding this framework really offers valuable insight into the safeguards in place for those who've served.